Would you take out a mortgage if you would never ever pay it off? Or maybe take out a mortgage and it's still around even after you die and it gets passed on to your grandkids? Well, a lot of Americans are talking about it today, especially after the Don revealed the 50-year mortgage plan. And I think this is something good to cover because Americans nowadays are financing their burritos and Panera Bread and Starbucks. So I think a lot of people would opt into this 50-year mortgage, but there's 5 things that the Don may be overlooking with this 50-year mortgage plan. And today, I'm going to go over exactly what that is. If you're here for the first time, my name is Tein with Millennial Wealth, and I make personal finance simple for those people that are trying to build wealth and not just income. On paper, a 50-year mortgage sounds amazing. Lower payment, more breathing room, less pressure. But the truth, there's some nasty fine prints hidden underneath, and we're gonna get into that. So the first thing that most people are overlooking with these 50-year mortgages is that the reality is that your payment won't drop nearly as much as you think. Because most people think that you're going from a 30-year to 50 years, so your payment should nearly cut in half. But it's not even close because the reality is most lenders, they're going to price that into the loan. So in terms of getting a higher interest rate and as well higher risk premiums when you go for the 50-year versus the 30-year. To give you a perfect example, you get a 15-year mortgage, your rate on that is typically about 1% less than a 30-year mortgage. And you typically will have less risk premium, so less closing costs than a 30-year mortgage. And the payment difference between the 30-year to the 50-year is probably going to be about 8 to 15% cheaper than the 30-year and sometimes even less. And you're basically stretching your loan forever, but the payment barely moves, right? So you're getting a small win today, but a massive loss later when it comes to interest. And let me show you guys a quick example of what that looks like. So in this example that I'm using, let's just say your home is about 400,000, you do 10% down, loan amount 360, interest rate 6%, loan term 30 years, property tax 5,000, PMI 0.5%, home insurance 2,000, and this could vary depending on who you are for credit wise and as well where you're at for taxes and your home insurance, right? So in that scenario, your monthly payment would be about $2,891 with PMI. Without PMI, $2,741. And that's after 88 months by default, where your principal is going to be less and you have 20% equity or more. And this could be, sped up by, having a larger down payment or potentially, paying more towards principal as you have that loan. But now let's just simply change this to a 50-year. Keep everything else the same. With the 50-year, your payments are at $2,628 with PMI, $2,478 without PMI, and look at that, it takes about 227 months to get rid of that PMI by default. But that's like your best case scenario where if the interest rate stays the same as a 30-year, but I don't think that's going to happen. I think realistically it'll be just like any other mortgage where this will be higher because more risk for the bank. And this right here, we'll calculate that at 6.75%. And look at that, you're at $2,830, right, with PMI. So you're saving like about $60 there. And then without PMI, after 251 months, you're at 2,680. So it's really not going to cut your costs in half like what a lot of people are thinking. So I just want to show you guys the numbers behind it. The second thing about these 50-year mortgages is that you're going to be paying 2 to 3 times more in interest over time. And 2 to 3 times doesn't sound too crazy until you put into perspective that it's hundreds of thousands of dollars we're talking about, right? If you go with the median sales price around $400,000, then you're going to be paying close to $1 million in interest on a 50-year mortgage because you're going to be paying for interest for almost half a century. Doesn't that sound insane? Imagine buying a $400,000 house today, and in 2025, 50 years from now, 2075, you've paid close to $1 million in interest alone. And that's not home ownership, in my opinion, that's a lifelong subscription, because the reality too is people are going to refinance, right? And when you refinance, you're restarting the loan and you're going to have interest restarting again. And through the amortization, you're going to be paying more than $1 million on this. Uh, and let me just show you guys a quick example of what that might look like. Now look at this. On the total interest paid on a 30-year, 6%, you would have only paid about $417,000, right? And now you just change this to a 50-year with the same interest rate. You're at $777,000 for total interest paid. But again, let's go ahead and change this to 6.75, and you're at $898,000 for total interest paid. It's almost $1 million just in interest. So the third thing about these 50-year mortgages is that you're building equity at a snail's pace. And equity is the true wealth builder, in my opinion, because that's where, your principal pay down and then your property value goes up over time, and that difference is where you make a killing. And with a 50-year mortgage, well, with any mortgages really, through the amortization on the front end, you're paying more interest because you have a larger principal balance, right? With a 50-year mortgage, the first 10, 15, even 20 years is going to be almost all interest. Your principal reduction is going to be so small, so tiny, that you won't even notice it really. What if the market dips a little? You could be underwater for years, not months, because your principal pay down is going away so small, you're not going to notice it. And what if you need to sell or refinance earlier, as I mentioned, right? Good luck. You might barely be able to break even. And then on top of that, you're going to have more interest if you were to refinance again. And if you were to sell, where's your equity? There's not as much equity, right? You'll own the home eventually, like when your kids retire. Let me show you guys a quick example of this $400,000 mortgage, and 10 years from now in 2035, what that principal would be should they go with a 50-year mortgage versus a 30-year mortgage. With the 30-year mortgage, right? Everything else staying the same. Let's say on average, people sell 10 to 12 years. Let's say someone wants to sell 2035, 10 years from now. The balance on their mortgage at that time with the 30-year, they would be at $299, $961. Not bad, right? So you've paid down the good amount, almost $60,000 in principal. And then now let's go ahead and change this to where it's 50 years. Same rate, right? Everything else stays the same. And we're at 2035. Your balance is $344. So you would have paid in 10 years only about $16,000 towards that balance, right? But keep in mind, this is at 6%. Now let's change it to 6.75%. What's that going to look like? 2035, 6.75%. Balance 347,345. So literally less than $14,000 in 10 years of equity you would have gained. It's going to move at a snail's pace. The fourth thing that most are probably not even going to talk about is what are the hidden restrictions that they're not going to advertise? Because with any loans out there, there's going to become strings attached, right? Prepayment penalties, higher PMI, or mortgage insurance as most will know as, right? Strict recast limitations. So recasting is essentially when you go to pay a large balance to be able to bring your principal down and recast the loan so you could get a lower payment. What are the restrictions on that? Balloon clauses, right? And also what is the refi requirements going to be if someone wanted to refinance out of that, right? And these are things where for the banks, the longer terms make it easier, but what they really mean is they're going to lock you in, right? It's freedom on the ad, but potentially you're locked in with the fine prints in the contract. So this is something that if it does come around, you really need to find out what are the restrictions behind these 50-year mortgages. And the fifth thing about these 50-year mortgages is that the lenders are going to love these loans because they're going to make a fortune, right? And I'd be more curious on if the bank is going to incentivize the lenders to push these 50-year products out there, And that's where it's going to get really iffy, because there's going to be some people that are not as educated and can easily afford a 30-year mortgage that would lean towards a 50-year mortgage because they're being pushed by the lender and not being really ethical about it, right? Because the reality is there are 40-year mortgages out there already that most people aren't even aware of. And this is typically done when someone's going through a forbearance aspect, right? And these people, the 40-year mortgages, sometimes it's been helpful, but in some cases I've seen people where it hurt them even more when they eventually wanted to get out of the house overall. So this is something that you really need to consider if they do eventually come out with a 50-year mortgage, is knowing that you eventually want to become debt free, right? And with the 50-year mortgage, there is so much fees and interest over time, and it's half a century. Do you really want to sign up for something like that? Because you do want to eventually become debt free, right? And if that's the case, then that's something to really consider before you sign something like that. So here's the thing, this video may make it sound like I'm completely against the 50-year mortgage, but I'm really not. At the end of the day, being in real estate, I know there's a solution for everybody, and this video is more of so people can kind of consider before jumping into something like that if it does come around, right? Because the reality is the 50-year mortgage may be nice for investors, for example, who cares more about the monthly cash flow being a little more. They just want to maximize the cash flow as much as possible. For people that are maybe in higher priced markets, right, and they need to be able to get into something alternatively besides renting forever, then that might be somebody who might be better for. Or maybe if they're guaranteed a income jump later, more speculation play, right? And the one thing that I really hope everybody considers, especially the Don, is really thinking about the repercussions before they roll it all out, because I do think that maybe something to more explore of is the portable mortgages instead, because that would be really neat, where if you can take your existing mortgage when you go sell property and just bring it on to the next property, right? That would be really neat. I think there's less repercussions with something like that, and better for the economy, because with the 50-year mortgages too, as I just mentioned, investors are going to love it. And we're trying to solve a housing affordability issue right now, and I don't know if that's really the way to go about it, because investors are going to love it. Especially the ones that are looking to maximize cash flow. I'm personally on the fence against it, but knowing real estate is like, if I run across a deal and I start underwriting, okay, it works a little bit under a 30-year mortgage. Let me see what it looks like under a 50-year mortgage, right? And if that option's there and you can beat out others, and then you get that property, and I'm holding it long term anyways, it might be something I would consider, right? So, but anyways, I hope you guys enjoyed this video, and if you did, please hit the like button, and as well comment down below. I want to hear your thoughts on what the 30-year mortgage versus the 50-year mortgage, and as well, what are your thoughts on a portable mortgage option? Because I think that's really the solution to be able to solve the housing affordability. I think 50-year mortgage is going to create other issues that we currently don't have, that we don't really need to kind of explore, right? Because they already made a big mess with the whole COVID situation, and where interest rates were super low. I think that broke the housing market bad, and we really need to be able to catch up from that. And I think that portable mortgage might be the way. Hope you guys enjoyed the content. Take care.